Good evening. We have Jack here, the Jackal, on his on the new member introductory complimentary free sessions. You get 2 of these. They're extremely helpful. And if you want to continue further, you can obviously sign up for the advanced coaching sessions. Whichever the case, we want to get you a running start. And that's the purpose of getting these 2 very useful training sessions out of the way. So this is the first one. Normally we have a few other people too, but I'd like to, as new members come in, they do it as a group, but it's good to do it one-to-one too, so you can address some of your direct questions and stuff, and I'll be able to answer it. So let's try to make the next 60 minutes plus useful. Full disclosure, this is purely for financial education, not for any solicitation or advice. This session will be recorded, uploaded to the YouTube channel, and so it'll be available to you on any other new member who'd like to learn some of the basics and on what we do here at Clueless 8 Trading. So all that covered, let me begin. First of all, what I'm going to do tonight is I'm going to take a little bit of a running start. And what I'm going to do is pull up a couple of my charts, and I am going to walk you through them, so you will be in a better position to read them and try to understand some of the messaging that I'm trying to put across. Because you'd be really surprised how with how many people out there, especially newer members, that despite all the arrows and the supports and the resistances and this and this and this, which are like a very detailed GPS roadmap. If you don't mind, Jack, just lower your volume on the other side because I'm getting a lot of feedback.
Okay.
Yeah, just you can always mute yourself, or you can come back online whenever you need to ask a question. So all right, so bottom line is you'd be surprised that they're looking at these charts, but they're not quite understanding even 10% of what I'm trying to message on these things, because these are critical for both active day traders, and they're extremely critical for active swing traders and for anybody who's trying to play these markets. So that's what we're going to do. So we're going to walk through the basics of each of these individual lines and stuff like that, and then I'm going to open up and ask you what you need to basically focus on, and we'll go from there. This is what we're going to do on the first session. Fair enough?
Yep.
Okay, that sounds good. So let's start off with this chart. This is a chart of the E-mini futures, S&P 500 futures, the 1-hour charts. Got to lower the background feedback a little bit, Jack, because I'm getting a lot of noise coming from the back.
Okay.
Yeah, because you got you got a great microphone. You got a sensitive microphone. It's picking up all the noise from the back, so it gets a little distracting. So what
how's that?
Much better.
Okay.
Much better, yeah. So starting off with this chart, for example, we use these futures charts. In this particular case, this is the S&P 500 E-mini futures 60-minute chart, 1-hour charts, as extremely critical roadmaps so that we can manage our trades. For active traders who have the ability to monitor all through the day, these things are critical. For people who are on the job, doing their regular day job, these are also very important because I update them and post them almost every half hour, if not every hour, depending on the volatility in the market. So they're always aware of where we stand. Now, for active traders, just like, somebody who's driving a fast car, somebody who's driving a nice bike, you know what I'm talking about. So basically, when you're doing the twists and turns, obviously you will be in a much better position to not get sort of fall off the road, for a better choice of words, or fall off the cliff if you have these roadmaps in front of you. For swing traders, like I've explained many times, these roadmaps, they even though if they can't really monitor it on an hourly basis or anything like that, at least they give you an idea whether something dramatic is about to happen, things happen. And as you know, on a real-time basis, you've been with us a few weeks now, that I'm very engaged on a real-time basis. So even if you have, even if you can take a peek at the tweets that are coming through here and there, you at least have an idea what the situation in the market is. I never leave anyone in the dark. And for all new members who are going to be listening to this, keep in mind that I am fully engaged on a 24/7 basis during market hours. And after market hours, I post some very, if there's some, huge catalysts that are moving after hours, I tend to post those too. But at the same time, during market hours, I am always putting out real-time charts so that people are never lost. And that's a key feature of my service. So saying all that, let's take a look at this, let's take a look at this chart and try to break it down so everyone can understand, especially newer members can understand what I'm trying to do here. So first of all, I'm going to go through it. And some people have asked me, so why do you use futures charts? Why didn't you use the S&P? I do. I show the SPX. I show the SPYs. The reason I use the E-minis or the S&P futures is because these are the first line of attack or defense. Because after all, trading is like a battlefield, right? So the first line of reconnaissance, where the snipers are seeing where things are going, which bad algos you're going to take out. These are the fastest and the quickest reaction charts to something that's going to be happening within a minute, if not minute is a long time, within let's say 30 seconds or 45 seconds on the front end. Okay, that's the reason why I use the futures chart. Now, we do have futures traders too in our group who use this extensively to make pretty substantial profits and minimize their losses. But that's the reason why we use the futures chart. But not because we're trading futures during the day. Some people are. That's fine. I'm not. I'm trading stocks and options during the day. So these are just very precise roadmaps because they react instantaneously. They are the ones which pull the strings as to what will happen on the front end of the market. So that's it. All right. So this is the S&P 500 futures, which determine on a large degree what is happening on the front end on the Dow Jones and the major indices. And here is how you read them. So what I do in the morning, first thing in the morning, pre-market, I put out these charts with all the levels and everything that I have from which are going to be relevant for that particular day. So that gives you an idea. I'm not going back, weeks and weeks here. Those I'm showing on the longer term charts because that won't make any sense, as you can clearly see here, right? What I'm doing is I am showing you what is relevant right now and how so you can react to things, know where to take your profits and things like that, because each of these levels that I have drawn and structured are almost always engaged, even today. So so I'm laying down a roadmap prior to it happening, just in case this, where if this doesn't blow up all the way up here, rally up there, it's going to hit these levels, and then the sellers are going to come in, and so where the low end is, so you don't panic and sell right at the bottom. And you don't panic and buy right at the top. And I always put out the comments when I'm putting these charts out. If you notice today, I told people to take some at least full or partial profits on a lot of trades that were running like a monster during the day. And the level was right here. And it was pretty obvious to me. And for anyone who's reading it, it's obvious to them. So let me walk you guys through it here. The lines which are the green lines here, and I'm starting from the basics. The lines which are the green lines here, sometimes I do it in dark blue. These are your upper level resistances. These are the levels if the market really makes these type of massive breakouts like it did last week on the 20th, they are going to hit. And at that point, you're going to see the algorithmic high frequency trading programs and the institutional hedge funds and things like that start to take some of the profits. Very few times do the markets act randomly. People who don't quite understand technicals, deep technicals like I show, they think that everything just happens by chance. It never does. Everything has a certain level, and the markets and the machines and these black boxes, which are super fast computers, are programmed to react to certain levels on the downside if a certain type of news hits the tape. And sometimes the news can be so dramatically different. What we call a black swan event simply means that it's unquantifiable. That's when you get a massive flash crash. So in that case, levels are broken to the downside. And even then, my charts will show you how low they can go. And this is obviously a short-term chart. I'll show you the longer-term one. So you know pretty much where you can fall to. So you need to get out, buy at that level. At least you have an idea. So I'm making sense so far?
Yes.
Okay, very good, sir. Stop me if I'm not. I'm always, I'm obviously here to make sure that you're grasping what I'm explaining. So saying all that, what I wanted to say was the markets in general are not random. Those were the old days when humans controlled the market, and human emotions are somewhat random, even though they're predictable. People get scared, they sell. People get excited, they buy. But in general, human emotions sometimes can be unpredictable. But machine-driven markets, you can predict the moves by basically using these roadmaps. So as I was saying, I just drew another line here. That's a downtrend line. Good. So as I've said in many of my other videos, which I know you've looked at and stuff, so here you have your major resistances. I normally put it in a thick green line or a thick blue line. Then you have minor resistances like this one here. Then you have another resistance right here that was created today, right after the Fed. We went up, we came down a little bit, then we started running, and the market went exactly here. At that time, if you go back to my charts on my real-time Twitter feed, you will notice that this line here, which is basically what we call a long tail hammer, inverted hammer. It's an inverted hammer. It was bright green. It was bright green, and it was meant to basically get up here and hit the 2940 level. It was meant to do that. However, a large block of a sell program came in. Fundamentally, nothing changed in the market, but there was one big program that came in, a sell program, which I was noticing on my other monitors too, and I showed it also on real time, which caused this hammer to start to shrink the green body of the candle. The green body of the candle. That means they're not sure whether they want to go down. They're not sure they want to go up. There's a bit of turbulence for about, and remember, this is a 1 hour chart. So each of these candles depict 1 hour, right? So that hour around 3 o'clock, they were wondering, this was green for a lot. And then it started to shrink, and then there was this little, little red box right here with a long tail. That means somebody was getting pressured out. And when you start getting these one large program coming from wherever it came from, I kind of have an idea where it came from. Partly, I don't want to get into it too much, but I did explain it quickly. There was a big blast there was a big crowd on the institutional side that was betting that the Fed would, that the interest rates, the 10-year government bond yield and the 5-year government bond yield and the government bond market, basically the yields would move higher. So because the Fed is hawkish, they want to raise rates higher. However, if you read in between the lines, the market reacted differently, and yields actually went down. Interest rates went down, and they fell quickly. So when you have fall quickly, that large group of institutional hedge funds, which were betting that rates would go higher, they got caught in the trap, right? So all of a sudden, they started selling. And when they start selling, it has a ripple effect across the board on other portfolios also, because they don't just own, they didn't just bet on the government bond rates moving higher on the Fed meeting. They also have other stocks in the basket. And so you have this sudden sell program that comes in, and there were some other factors going on too. But there was no fundamental reason, because that's what the normal person out there thinks, right? Oh, something really bad happened. Nothing bad happened. There was no change in any of the companies. Nobody warned. Apple didn't come out and say, "Oh my God, we didn't sell any iPhones." There was nothing like that. It was a technical, robotic, algorithmic, high-frequency trading sell program that came in, and I gave you my guess where it was coming from, and that pushed this candle to develop. This candle didn't look like this. This all happened within the last 20 minutes of the market closing. So that's why these charts are important. They were holding very well this particular red line here, which was a major support, which I had said many, many times, the 23.18 level, because that's where the rally began back on the 20th of September, last week. That rally took the shorts out to the slaughterhouse. Okay? And we had that rally started on Thursday. 20th was a Thursday. We were prepared for it. And those SPX and SPY calls and stuff that we had bought in this range the previous day and the day before, based on my analysis, I called this a bull flag. And I was dead right. Those things were up a gazillion points. That's also when Apple went berserk. Remember? That when it looked like, oh my God, what's going on? And then it just, and that obviously took the market higher. Bear with me 1 second. So, saying all that, generally speaking, the market retraces back when you have, this is called the impulse, it's called an trying to get the pen. All right. This is known as the impulse breakout, a sudden breakout. You can see that just by looking at the shape of the candles, like straight up. This doesn't happen again. There was nothing really fundamental that changed. There was some good news. There was a technical breakout. And that did exactly the opposite of what it did today, which is trigger the stop limits, stop losses. Institutions have stop losses and stuff on big portfolios. Retail traders always have stop losses, so they took them to the woodshed. So here, they took the shorts to the woodshed. It's just the way things work. And it happens instantaneously. And then, so this was a major support level, and I always draw the support levels in red. That's the line.
Yep.
The green line here that you're looking at is, I always put these greenish or light pale green, whatever you call it, those are the main colors they use, are gaps. That's a gap is a gap.
Yep.
Where, you get a gap up, you get a gap down. So there's a minor gap here, and I put it there as that the gaps would get filled. Twice this gap got filled. One was on the 25th, and one was on the 26th, which is today. And it got filled, it overshot, it was meant to get here, but like I said, a big sell program came in right through the middle of moving up. That's why right now, as of now, I have a green resistance line here, because now that has become resistance. And that resistance needs to be taken out in order for the market, and that resistance is roughly around 29.36. So that resistance needs to be taken out before the markets can climb higher. And so the green lines are the resistances, upper level boundaries, and the red lines are the lower level supports. And that's the most basic thing when you're looking at my charts here. Second thing, let's move on to the next one. The next one is you need to train yourself a little bit in due time. Some people catch up, pick up these things faster. Some people take some time. Are patterns. No, actually, I'll go into the pattern as the third thing. What do you call? The next thing I want to show you are these, the slanted lines, and these are basically channels. So this is a wide channel.
Yep.
You can see that.
I see it.
Yep. And this line here is a pattern. I could also draw it as a channel, but I drew it as a pattern known as a falling wedge.
Right.
And that falling wedge, and like I said, keep on reviewing the pattern analysis video. There's tons of stuff on patterns, teaching all the basic technical patterns on YouTube. There's some guys with, like I always say, like 1 million hits. They're just explaining the patterns and stuff like that. Great to listen to those, because it's very, very important. Because after all these years, I look at them, I look at something and I can already visualize a pattern, before it even happens. And that's just, it's not sixth sense, it's just practice. That's all, Your brain,
I hear you.
your brain gets wired to understanding it. You understand that part. Any profession, you do it over and over again. You learn the skills, and you start to see that. Are they always going to be exactly correct? Nope. But are they going to be mostly correct? Yes. Okay, that's just the way it works. So so these are the uptrending channels. This is a downtrend line, two downtrend lines which are converging on each other. That's known as a falling wedge. Falling wedge has a very high probability of breaking out, and that's exactly what it did. That's exactly what it did here at
Yep.
around noontime on the 23rd, which was Friday, right? What day was the 23rd? 23rd was actually a Sunday night. That's what it did. Because these are futures, so they are seamless. The futures trade 24/7 almost. So this was Sunday night, September 23rd, is when this started happening. Whichever the case, this was the Friday close. The Friday close was the 21st. Yes, 21st, and it was right here. So I'd drawn this falling wedge, and the markets fell a little bit, and then it started to rise. It filled the gap, tried to go over it, fell again, tested this level again, and you notice I have arrows, which make it extra simple to understand.
Yep.
Because remember, I'm trying to give you the basics, and all my new members, and all my members in particular, I'm not asking anybody to become a serious expert. Some people love doing this stuff. They do it more and more. They try it on their own stocks and everything. They're like, wow, this thing really works. What I'm trying to do is just so that you guys can understand the basic messaging that's coming out of it. The more advanced messaging that comes out of it is very useful, especially when market gets very volatile. And for that, a lot of people sign up for the ACS sessions or simply practice on their own to understand my charts better. So the key thing is, and that really, really helps when you're trying to manage your positions in an extremely volatile market, all right, which is pretty much every day. So it hits there, it comes down, so you have the support level. So you have the channels, you have the falling wedge, then the red line slanting down, basic stuff, is a downtrend line. The blue lines slanting up are channels and uptrend lines.
Okay.
And that's really what it is. Now, anytime you're trying to enter a channel, there's going to be some selling involved there. I'll give you an example. Right now, you see this channel which was drawn all the way back from here, from the beginning of the month. This blue line, for example, right? And this blue line here, and then I draw, and then I connected. Now, each of these lines are not randomly drawn. Technical analysis basically says you need to have at least two, if not three is much better, contact points so that it looks like a actual symmetry. Symmetry is very important. In nature, love symmetry. They're like, we like things which are, what's a beautiful motorbike or a beautiful car which has symmetry, right?
Yep.
Not like a jello thing just thrown out there, right? So it's not that. When it has symmetry, you actually see the beauty of it. Symmetry on technical charts, you tend to do much better in trading and using those charts to make a lot of money, or losing less. But primarily, we're in the business of making a lot of money. So when there's symmetry, it's fantastic. So each of these contact points here, you'll notice 1, 2, 3.
Yep.
And so that is it. And so when I drew this one, I basically took a parallel, and you can do this on your side too in any platform. You basically draw a parallel a duplicate line, and there's a total symmetry here. So if the world was a totally if the market was a totally normal place, which it certainly isn't, and if it was completely normal, we wouldn't have the opportunity to make these 50, 60, 100, 200% type of profits, because then everybody would know everything, and everything would just move sideways to slightly higher. That means you would never get the opportunity to buy these type of depths, and make those serious money that I've shown repeatedly that can be made. If everybody had the same information, looked at the charts and looked at everything the same way, the market would be doing this. There would absolutely be a low volatile market. That means you would basically make about 10% on your options probably, instead of making 100% and doubling your money. You understand what I'm saying, right?
Absolutely.
Right. So therein lies the opportunity. So if the world was even a half normal volatile place, let's say with volatility, we would have followed this channel like this, higher. All right. However, the market decided to take a scenic route and break below this channel, this wide channel that it was following since the 16th of September, and that's why I have this line drawn. It decided to break down below that on Friday. What day was it fell out of the channel? Let me see here. Yeah, Friday at the close, 9:21, right there, and it broke below that, and then basically fell into a trading range, which we are in right now. By the way, this is the trading range that we're in right now. I know we slipped below it today, but I can pretty much assure you that they will try to get back into the trading range tomorrow. And then we're going to be stuck within this trading range again till we make a big breakout. That's why I have the arrows. Now I come to the arrows. These arrows are designated showing you the possible outcomes of what might happen. If we come here, there's going to be some selling. Why? Because that was the last supply point. Supply is simply a fancy word for saying that there were sellers here, right there, which was 2 o'clock on the 21st, on Friday. See that? Right there. So that's why I drew this line here, because right when the market gets up here, which it will, around 29.40, you're going to see sellers come in. Because whoever was trapped here now is break even, as I explained on my previous videos. They are going to be selling. They're like, God, there we go. I'm break even. They sell. That's why it becomes a resistance. That's why I have this line here. We were supposed to go there today. However, like I said, this sudden sell program came in and pushed it down. So saying all that, the arrows are meant, and for everyone, a lot of people don't even understand these arrows, so I'm going to make this real clear. These arrows basically are telling you where the sell points are and where your entries or exits should be. So here's a major support level. We almost got there into that hectic sell-off in the last half hour, right? And this was the breakout point back at 8 in the morning pre-market on the 19th, which was Wednesday, right? What day was the 19th? I got to put the calendar up here. Yeah, 19th was last Wednesday, sir. You're right, Jack. So if you notice, look at this. So here on the 19th, everything's like, pulling back a little bit. And I said this was just a consolidation channel, basic profit taking after a V-shaped move, or, what we call, it can be looked on as a cup. But a V-shaped move, this was just standard profit taking based on what I saw underneath the surface on the stochastics. And that's exactly what happened. Like clockwork, boom, it broke out. And then it decided to make that killer move the following day, which basically a lot of short funds lost billions of dollars within a matter of an hour or two. So they wanted their revenge, and they got it today. You got what I'm saying? That's just the way the game works. The market is completely, this is for all members, all new members, old members, the market is completely manipulated. Nothing in the market, in my opinion, overall, happens without the invisible hand of the machines or whatever you call it. In the old days, 3 or 4 firms controlled the market. Nowadays, there are hundreds. Okay? The big boys are always there. But the big boys alone cannot fully control the market, manipulate the market, because of the number of players in the market right now. From here to Europe to the Middle East to Asia, there's a lot of money flowing around. However, overall, the market is manipulated, and nothing happens in just for fun. You understand what I'm saying? So that's
I do.
Yes, as long as we understand that, we're going to be fine. We're just going to be fine. So if you notice, so on our markets, what controls the market are primarily the big institutional commercial futures traders, because when they are selling a whole block of big blocks of futures, E-minis, or buying a big block of E-minis, they are going to sway the market on the front end in a big way. The machines, which are the medium to small size players, they they are not the ones controlling the market. They are just like feeders. You know what I'm saying? They're like hyenas. They're like jumping on the prey and they're just going nuts on it. So the big boys, when they move, they are not normally using algorithmic high frequency trading programs. They are just using fast machines, but you can see their footsteps. And that's why when these breakouts happen, it's basically those guys squeezing the shorts. Anyway, bottom line is, this is where we started. We bounced off of that twice, and that's where we were bouncing off till the last of the sell programs. I mean, sorry, the limit stops went out, triggered, boom. You know, there's a lot of day traders in the market too, right, Jack? So they are, by according to these prop trading firms and stuff, that people basically go day trade. They have to close out their positions by 3:30, and that's exactly, they're like, no, I want to hold it overnight. No way, boom, they sell it. You got it? So this
Right.
is the last of the moves. Now, saying all that, there's another major support level where the market basically broke out of, and that's here. That's why I have this thick red line here. That's at 29.05. As somebody who's overall long and did take some very nice profits along the way too, today and every day I do that. I don't like seeing very big, large profits, and I tell my people that too. Got to take partial or full profits out of the way. I don't care even if it grows higher. I have had more instances where I've sold a good bunch of profits and the stock has run up against me more, especially the Amazons and that type of company. But that's okay with me. I feel terrible sometimes because I should have held that big fat position. But then when something like this happens, I feel great because I took down a lot of profits. So you got to do that.
Exactly.
And it doesn't matter if it's a small account, and it doesn't matter if it's a large account. It matters if it's a very large account because that means you might be up large accounts can be up 15, 20,000 bucks on multiple trades, and before you know it, something like this happens, they're down in the red, and that's a terrible feeling. That's a terrible feeling.
They always seem to go down faster than they go up.
Well, that's life, right? That's life.
Yep.
Fear sells better than happiness. It's
Exactly.
life. So it's the same. It's a human psychology that doesn't change. Fear and misery and all that stuff sells a lot more. It's a multi-billion-dollar business selling that than trying to sell like, oh, things are really good. You know what I'm saying? So so markets are the same way. And in general, you want to protect your profits and stuff. So obviously, people sell quicker. And plus, on top of that, the mechanical, the market reason behind it doesn't matter the fact that we are making new highs in the market and stuff. It's still an extremely volatile and dangerous market, right? Just on a short-term basis. So people react a lot quicker on moves down than they react on the move up. So that's one of the reasons too why the markets keep on chugging higher, because most people, majority of people, I would say, and that includes traders primarily, are not really making the money they should be making. And we are trying to capture a lot of it, but I would be the first one to say, I'm a straight up guy, I'm not making what I should be making given the type of precision charts and everything that I'm creating, because I'm also selling out a little bit too early instead of and leaving too little for those big moves up. But I'm still doing a heck of a lot better than somebody out there who basically is not even buying these technical lows. You know what I'm saying? Who's not even buying these technical lows, maybe chasing it up here and then getting smacked again because they're going with emotions. And what we try to do here at Clueless Ape Trading, we try to remove the emotions as much as we can. But then when we buy some of these things and they go rampantly higher, we have a tendency to sell out a little bit too early and then see it still climbing higher, right? Well, that's fine as long as you're selling on the way up. It's much better than selling on the way down, Jack, and that's the number one rule. And the machine will make. And I can tell you one thing, and you'll see this happen more and more. And you'll see this now depicted on my charts, and you know this. The machines will always try to get you out of positions, get your stuff, your good stuff cheap, and then run it up against you. And that is the worst feeling in the world. And they do this all the time. And we have shown this repeatedly. They'll take your Netflix calls away at $3-4 and then run it to 16 the next day. And this happened just within the last 48 hours. The Netflix 367 calls were down to like $4.5-5. They were at 16 today. So, you know what I'm saying? So they'll do that. So the only way that you can minimize that type of heartache and real pain, and that's what you don't make is what you lose. Basically, that's the business of trading. The only way you can minimize that type of situation is by going through is basically try to be as much of a tactical trader as possible. So saying all that, this is a major support level here. That's why it's in red. Then somebody might wonder, well, why do you have this line in green? Well, this line in green was put in place way back. It was put in place on the 13th of September because that was the last major breakout. See right there. So this, you see, it was a triple top breakout. You can see that. 1, 2, 3. It broke out, made a double top, and all of these things happened within 24 to 48 hours. And that's why I have a 70 to 80% accuracy rate when I say that we're going to have a reflex bounce based on my indicators and stuff, a sharp reflex bounce within the next 24 to 48 hours. You've heard me say that, and you have actually seen it happen. I'm not a magician. I don't have a crystal ball. The only crystal balls I have are the charts that I structure. When things get deep oversold and there is no fundamental reason behind it, the machines will, again, just the way rock the boat higher, they'll rock the boat lower and they'll bring it up. It doesn't mean we're making a new high. It simply means it's going to go back and attack those previous levels where they failed. So far you understand what I'm talking about?
I do.
Exactly. So saying all that, so that's the reason why I had this line drawn here. This there was another flash crash here that was back on the 16th, and then it just immediately ramped up. Right when the markets opened. What time did this start? It's hard to keep track of these heavy, hardcore, extreme volatility moves. Okay, so this started at in the evening at 8 p.m. 8 p.m. That's why it's funny here. 8 p.m. on the 16th. 16th? On the 17th. And you can see that it went exactly back to that level again, made that consolidation, and then I already told you this part of the story. You understand what I'm saying? Exactly. So now, sometimes on my charts, to help people. 1 second. Sometimes on my chart to help people, I actually put, if it's a major pattern breakout, I will put the name of that. This is an ascending triangle breakout. Because bottom line is, if you go back all the way here, this was a big, this was like there was your ascending triangle, okay? Yep. That's what they know. That's what an ascending triangle looks like. So it did that, and the ascending triangle breakout, basically this was the triangle, to be honest with you. And that broke out on that wild impulse move on the 20th. Just like a monster. And generally speaking, once you get an ascending triangle breakout, you will, a high probability, come back and retest it. That's what the markets did the following 2 days. Today it tried to, and then it slipped lower. Futures are up 3 right now. You can see that develop. But that's pretty much, So the more you look at these charts, the more they talk to you. Any questions, anything any new members might have, feel free to connect with me directly on the website chat room. Send me a quick DM, but don't come up with 30 different questions in the middle of the trading day, because it is not physically possible for me to answer all that stuff. For those, like I said, you can come into the website chat room. Any questions asked is answered almost immediately. So that's important. And then, of course, you take your time and sign up for the ACS sessions where you really get to understand this stuff. So, saying all this, this is a 15-minute chart. I'm sorry, this is the hourly chart. It's cutting out a lot of the noise, and you can see what's going on. And so that's it. This one is a 15-minute chart. This is for active traders. You can see there's a lot more noise, as in the number of candles, because each of these candles are 15 minutes. This is a great chart. Now I got to draw another line here. 1 second. You can see this is where we slipped, right?
Yep.
So there we go. So now we have these long tails. Long tails simply connotate that there was short covering going on. And let me make sure that this now this becomes, make it a little bit less thicker. Okay, there we go. The thickness of the lines generally denote are showing the level and the power of that support or resistance. If it's a very thick line, that means that's a really major support, like this one, which is at the 2900 level. If it's a kind of a mild thick line, that means that okay, it is support, not that important. Just try to basically show those things as much as I can on my chart. So this is a 15-minute chart. We traded it extremely well. I'd like to explain a very simple thing that happened today. I mentioned a couple of times that the Fed day is generally a three-wave move. Okay, you get the first move higher, that was right after the meeting, right there. The second move lower, that's why I had these arrows for somebody who didn't understand. So this green arrow was the first move, wave one, right after the Fed meeting. All right.
Yep.
So then comes 2:30, right here. Then the Fed Chairman Powell starts to talk. Markets start to pull back a little bit. So that's normally known as Fed Wave 2. There are no rules to this, but this is the way it normally happens. Once Wave 2 started to come down, you actually started to see buyers show up here. Buyers show up here. And then I noticed that the buyer, the market was starting to move higher. Then it started to slip. This is not recorded in live in real time. That's why you can't see that. But then you started to see this green candle appear right off the bat. And I had put a nice arrow here showing that this is where we're going to bounce from. Well, we were bouncing from there. The arrow was looking like this. It was looking green. It was looking green. I believe I posted that on the thing showing that the wave 3 was on. Because today I really posted in sequence so people who want to understand a little bit about how these things work. Because this movement higher here, looking good. P&L's going higher on the long positions. But then suddenly this candle appeared and it started to gain steam, and that's when all hell broke loose, and they took all the weak hands out to the woodshed. So it's okay for traders to basically sell out once they see this type of things developing, but the best time to sell out would have been here when I told people to take some nice profits based on the resistances that came through when we were filling this gap. But remember, the best time is to buy when you can. I mean, sell when you can, not when you have to. That's an old saying in life and in trading. Sell when you can, not when you have to. So I tend to be a big seller on those big rippers
Yep.
on certain days. Sometimes I regret it because I sell it a little too early, but that's okay. I tend not to get too excited with, and those are the days you see a lot of retail emotional traders tend to buy, and then they get chopped. So just the way that's on the buy side, this is on the sell side. You do not necessarily need to be a massive panic seller and then watch the market drift higher all through the night and gap open, and you're like, what the hell did you do? So this is something you'll see occurring a lot. Today's action was a little bit abnormal, primarily for the reasons that I explained in the first part of the session. A big block sell came through because of things that happened in the bond yield market, in the government bond market, and then that caused the banks to fall, which I mentioned. And when financials, which are a big weight on the S&P 500, the JP Morgans, the Goldman Sachs, the Bank of Americas, they were starting to rise when this green candle was developing, and then all of a sudden somebody just let it go, and JP Morgan just dropped like boom, like $1. A stock like JP Morgan, a component of the Dow Jones Industrial Average, moving down $1, it means a lot of billions of dollars just got washed out. You know what I'm saying?
Sure.
So that pressured the market big time. Banks pressured the market. Techs were overall fine. All the techs were holding up, but they can't withstand the rush of the little tornado or blowback on a big sell program that came in from the financial sector, which was the cause of that was what happened in the government bond market. So that's it. So saying all that, this is your 15-minute chart. It's extremely useful to catch the early beginnings of a move. So I showed this chart very clearly this morning, and anybody who followed it basically made a very decent sum of money, because you could see the candles develop. You see how it went up, where it hit the gap, where the sell zones were. So even if I did not make any comments all through the day and I just put these charts out a couple of times during the day, somebody with a keen eye can easily manage what they need to manage. So this type of sudden volatility that happens, very difficult to manage. I'll be the first one to admit that. There's no way you can quantify it. That's just like falling off the cliff. Just the way this was for the shorts last week. This was like a nightmare, right? So this was just like a nightmare. So for the longs, this last hour was like a bit of a nightmare because of the flash crash, and just the opposite happened last week. They were like, what the heck is going on? I mean, that's when they just decimate the shorts. Billions of dollars lost here, maybe a little less lost here today for the institutions who were long. Got it? But you can see the same thing happen. So just the way there's a black swan event, like a quick flash crash, there are flash crashes that also are flash melt-ups, right? That's just the market, today's market that we live in. So now, let's move on to the longer-term charts, where we keep an eye on the bigger picture, and I show that in the form of these type of charts here. And these type of charts, all you got to do is glance at them. You don't need to super analyze them because they're not necessarily trading charts. These give you an idea whether or not we're in a big down market or whether whether the uptrend is still intact. So as you can clearly see here, based on the channels, these are all channels, and this is going back to 2018, right? So that's why I have this big thumb here. I think I had 2018 written here somewhere. But this is January 2018. So this is where we started. This is where we are. If you look at the channels, Jack, you can clearly see we're still trending higher. Now, once these channels are broken, that's why I have this big red arrow here, which is around 2866 on the S&P 500. Okay, on the E-minis futures, we're roughly around 2870 or so. Add a couple of points to these numbers in order to arrive at the actual S&P number. So once you break that, you can clearly see that at that point the market could be in a free fall. Of course, before it breaks that, we're not going to be sitting here with our eyes closed like an ostrich with their heads buried in the sand. We would be taking preventive action and go on the short side through SPY puts and SPX puts and other things that we do, VIX calls, if we break below these trend lines here, which are still trending higher. See that?
Yep.
When this was going on last week, now remember, this is a daily chart, so each of the candles is 1 day. So there was 1, 2, 3, overall 1, 2, 3, 4, 5, 6, 7 days of a sell-off. From the 14th, this started on the end of August. Yeah, on the 30th of August. You see this? You see this, right?
Yep,
so there were 7 days of a sell-off. So they're like literally, they're out there in the media like, oh my God, this is it, this end of the world. The techs were selling off, this and that. And I repeatedly showed on another chart, I'm sure you've seen that these were just consolidation channels, not big breakdowns. Each of my charts are designed and crafted for maximum delivery. What does that mean? It simply means that if you understand them reasonably well, you will maximize your profits on any type of market. Doesn't mean you have a green P&L every day, but you will overall keep most of your money and not give most of your money back to the market. Each of the charts are crafted with very serious detail, just like a very fine car or a very nice bike. You know what I'm saying? So you need to. And I fine-tune these charts along the way. They're not just left there. I fine-tune them along the way to adapt to the situations that we're in right now. So this one, for now, when people are looking at the longer-term charts, this is still looking like a bull flag or a consolidation channel. Things move up, profit taking comes in. On an uptrending market, as it has been, they break out. See that? So this is the tricky part. Whether it's going to be 3 days or 4 days of a pullback or 5 days, those are the tough ones to pin down. But generally speaking, if you just do a quick, aside from this one, when you do a quick thing, generally you get 3 to 5 days of a pullback type of move. In between those 3 to 5 days, you can have an update. But generally, that's what they are. 1, 2, 3, 4, 5, and then the market turns. So this one, for example, peaked 1, 2, 3. Maybe we have a slightly lower day tomorrow, but then you're going to see the breakout again. That's what at least what it's done. If things change, I'll be the first one to let you guys know. That's how you learn. That's how you read the longer term chart. Then we have another one, for example, This is what the naked chart looks like. A bang. Then I have the SPX daily. Do I have it here? That's the NQ. Okay, so this is the SPX daily. These are for people who are a little bit of more technically orientated. Here you can clearly see here, this is the beginning of 2018 right here. Sorry, this is 2016. No, 2018. What am I saying? I have the arrow here. So this was the heavy volatile moves that happened in the first part of the year. This is when everyone got super excited. What we call wave 5. That's it. The market can just never go down, and then they just crash the market. So saying all that, what we have a situation here right now is that we are seeing on the daily chart that this channel here, you have to focus on the line. This magenta line here, this comes into play just we are right here right now around 2907 or so on the S&P 500. This one looks like this channel gets engaged roughly about 6 or 7 points lower. This could be engaged by the time we wake up tomorrow morning or during the night when the Asian markets open, because you can clearly see here that it looks like it wants to get there. So this is a little bit troublesome, primarily because of the banks. This has very little to do with the text. This has to do with the banks. Okay? Because the banks got such a big hit today, even though it's only $1, JP Morgan was down. Somebody said, what's the big deal? Well, it's not necessarily a big deal, but it's the volume and how quickly it happened is the big deal. You got it?
Yes.
So that's why. So without analyzing and super analyzing it too much, it's still looking like a consolidation channel. That's why when new members are reading this chart, this is a consolidation channel right there. Here's a consolidation channel, these two lines. We have one more here. There's one more here. There's one more here. So this is for people who are interested in learning a little bit more about technical analysis. This chart itself, if you look at it carefully, spend a couple of minutes looking at it, you can actually learn a lot from it just by looking at it. This is also a cup and handle. These are the cups. That's what's the handle. Breakout. Cup. Handle, which is the consolidation channel. Breakout. This was another cup, a deeper consolidation. This is actually not a cup and handle. This was more like a W pattern there. Okay? And W patterns are powerful. And that broke out. This is another cup and handle here. This is the consolidation we're going through right now. The trickiest part, that's my job to do, is to try to figure out, reading many different signals, not just the daily, whether or not it's going to come all the way down here, which means a couple of 100 points down, about 23, probably another 200 points down, and bounce from there, or will it hold this and bounce? So this is something we have to watch out for. And this is something that I will be watching very carefully and letting people know in the next 24 to 48 hours, whether or not we are going to basically break below or whether we're going to. Now, when these type of things happen, you know better than I do, Jack, this can happen within an hour. We could have a 130-point down day, boom, get set up for another big move higher. The stochastics down here, which I use, and when people are looking at this, the daily stochastics here on the S&P 500 has broken the uptrend line. So that's a short-term caution. However, we could wake up tomorrow morning and this could be above the uptrend line again. It was above the uptrend line very nicely till that last red candle that hit the tape at around 3 o'clock. See how these things kind of all kind of connect and work? So it was doing this. I mean, I even showed it. It was like this, Jack. And because of this candle, boom, the last one, it basically broke below. Nothing to be super alarmed about, because this is a longer term. This is more of a longer term chart. The shorter term chart is already deep oversold.
Right
there, you can see that. So
turn it.
This is the most important thing that everybody who's listening to this, especially new members, should know. 1 hour charts will retest lows, get overbought. In other words, the market could very well have a 50, 70 point drop. Now we have a downtrend line in place that I just drew as I was doing this session. That downtrend line will act as a major resistance. So we could float higher. We could float higher for the first 2 hours of the day. Hit the downtrend line at around 29.28. I'm going to be alerting people that if they're up on things on that zone, they might need to take down some money, because at that downtrend line, which is now a pretty formidable downtrend line, we could sell off again. By the time the downtrend line gets hit, you know what the stochastics are doing. They're getting overbought. See?
Right.
This happens all the time. Look. See that? So when the stocks get overbought, it's not to say that it's going to immediately come down and pull the market down. Remember, the stochastics are the second derivative of the relative strength index. It's giving you a measure of the relative strength of a particular move in the market. So the stochastics are the second derivative of that, the first derivative of the relative strength index. So they are giving you the measure of strength, whether or not it's a lasting move or whether it's just going to go up there and then soften up again. These pullbacks that we see in the stochastics, look at this one.
Yep.
This one started here. See, stocks got overbought, stayed overbought, and then decided to reset. We call them resets. That's why we call them resets, right? Resets are nothing but going from overbought zones to oversold zones.
Right.
Once it gets into the oversold zones and then you start to see the candles turn, those are the ultimate buying opportunities. Those are the times people don't buy. And those are the times you can get the cheapest prices on select stuff, of course, and I try to be as selective as possible. And people trade their own ideas too. But if you use this chart, those are the times you will get your maximum bang for your buck, and you don't have to wait. And you could be selling right here and making a decent sum of money instead of waiting for the last of the pop, which most of the normal emotional traders tend to get into right at the last pop, when it just looks like it just cannot come down. You know, you get that feeling like, oh my God, this thing, if I don't get in, it's called FOMO, fear of missing out, right?
Right.
So the fear of missing out is basically this candle here. And guess what happens after that? The people like us who bought these levels, we obviously took our profits, and the little bit we have left, we take it here, and the big boys come take the profits. And hold on one second. It's my doggy. Hold on. Can you hear me?
Yes.
Okay. So bottom line is, so that's what it is. All right. So so the stows are very important. The simplest way of figuring out whether something is overbought or oversold. You do not want to buy severe overbought, and you certainly don't want to sell when something is deep oversold. You want to buy when things get oversold. Now, whether or not this is going to basically, and I've explained this in multiple videos, it's going to move up here, that is yet to be seen. If something dramatically, fundamentally changed today after the Fed meeting, which I highly doubt, okay, there are other factors involved too. There's the government shutdown looming. I'm sure President Trump is going to sign off the bill that was sent to his desk tonight. There is the Canada, you know, being stubborn and not signing up on the NAFTA. You know, the guys are being kind of silly, if you ask me. They're going to hurt themselves more. But anyway, so bottom line is that those type of things are also lingering on the market, you know. So bottom line is that generally speaking, if there was no outside noise, then markets, one way or the other, would still take profits, come down, reset, move higher. Come down, reset, move higher. Markets always do what they want to do, and then they look for a reason why they did it. I'm serious. You know, I'm saying most of the time. I'm serious. You notice that. You know, I've seen that over the years. Then they look for a reason, like, oh yeah, that's why we sold off. Yeah, then why the hell did we have this type of breakout? You know, what happened that great? You know, so so that's the point. They do the move, and then they pin a reason why they did it. There are certain things which are bad, clear, black and white. Bad for the market, certain things which are great for the market, but in general, our markets are fine. I mean, our economy is fine. The Trump team is doing a fantastic job on the economic front. Yes, we have trade wars with China and this and that. That is a big issue with the markets. But then even China's bending now. If you notice some of the articles that I put out there, you know, even they're lowering their import taxes on a whole bunch of stuff, textiles, cars and stuff, starting in November. So they got to buckle. They can't remain like we won't talk at all. forever. You know what I'm saying? So they're doing what they need to do. So coming down to technicals and charts, stochastics, watch it. I show them. I even put little arrows here showing that it's very oversold, and generally those are the points based on where the markets are on the front end. Remember, this is the back end of the market, the internals. This is the front end of the market. So if they're oversold and this is oversold, there's some nice entry points coming up. So we shall see tomorrow, whether or not we
Okay.
retest this. If something like crappy comes out overnight from the Asian markets and stuff, we know what the levels can be right here. 28.80, I would be buying, hands down, big time, because that was that start of a major rally, which lasted for about 3 to 4 days. So why wouldn't we like to get those same prices on that? So always have to have some cash on the side. So why wouldn't we love to have those cheap prices and ride the wave? Because down here,
Absolutely.
a lot of these stocks that we're trading, the Apples, the Netflixes, the Googles, the Amazons, they were 30, 40 bucks cheaper on the big ones, and they were at least 10 to 20 bucks cheaper on the medium-sized ones, right? So
Right.
it's always good to buy that. So okay, so that's so this is what we're looking at. Oops, sorry. Now let me walk you through this. This is a chart of the NASDAQ 100. I like to put a comment with my chart so people can relate to them. So this is an ascending triangle. Again, you can see that these two lines, it's an ascending triangle. More importantly, this is a chart that determines the ups and downs on the technology side, because these are the NASDAQ 100 futures. The NASDAQ 100 futures also incorporate biotechs, but this has a direct impact on actual technology stocks that we trade. So I watch it very carefully. Boxes and stuff that I put out, I explained it very clearly on my past video. These are patterns that I detected, so I highlighted them. Sell off, broke out. See how similar they look? You don't even have to count the bars. Just at first glance, look how similar each of these consolidation boxes are and how similar they are. You see that?
Yep.
Check?
Yep.
Sounds good, man. You're going to be a great chart reader, because it's like, I'm not saying this because this is a public forum, but coming from where you coming from and your experiences, some of the things you've done, sir, you'd be able to see these things just the way you saw them when you were out on the field. You know what I'm talking about, right? So
Yes.
exactly. So saying all this says if you look at this chart versus what we saw on the S&P, it's like nothing happened, right? Look at this. There was
Right.
this little hammer reversal, like this little one. I hope it doesn't get a big one, but this little one is so far not connotating anything. This is still creeping higher. Remember, there was a complete division between what happened today on the sectors. Banks fell apart because of the bond stuff that I explained earlier, but techs overall had very high relative strength. They stayed put. Yeah, they pulled back too, obviously, but they didn't crash. So bottom line is that's what's showing here. So this uptrending is still good. I still feel, based on what I see here on the technical side, that this will create and at least get to the upper end of this wedge or upper end of this ascending triangle. That means we should get the bang for the buck on the Netflixes that we're looking to fill the gap, which it did today. It almost entered it. 386, 390, those type of things would happen. But overall, the way to read this chart is to simply look at it. The first thing that the little voice in your brain tells you is what you go with. And the first thing that the voice in your brain should tell you, hey, it's an uptrending chart, because that's exactly what it is. And then if you learn a little bit more technicals, you look at it, you look at the fact that, the number of days that these candles were down, what happened after. These lines that you're looking at, these flowing lines, these are moving average crossovers. I'm using 5 and 10. Okay, 5 and 10. So you can use whatever you want, but I use the 5 all the time, because there are 5 trading days in a week, so I use 5. So these are just simply giving you an idea whether these moving averages are trending higher or whether they're trending lower. So right now they're trending higher. Okay with that. So that's the way you read the bigger picture. Went over this very quickly. 1 second. What we got here? So here's Netflix, for example. So this was the push at the last hour. Stock's looking great. The way you read these charts, there's a big gap fill. big downtrend line. We broke out of it. There was a range that the stock was trading in for a while, which was very profitable range. We traded, which is basically between 345 and 370. It finally broke out of it today. We have a big gap fill here. That's 385 to 396. I think it's going to fill the gap. Now, in between, if somebody, if as a trader, you trade when you get these big multi-day moves. This is the hourly chart, so this is like 1 day or 2 days. You don't necessarily want to just say, oh, I'm up so much, I'm just going to keep on holding because I know it's going to go to the gap fill. That's kind of stupid, because what happens is they take all that money away, you're deep in the red again, then you restart again, then you got to go up again. So best to do is to capture most of the move or the meat in the middle when you get these moves. Got it? So, and the simplest way to do it, which I've talked about strategies in many of my videos, explained very clearly on my ACS advanced coaching session, that you originally buy the calls which are close to the money, and then as the stock is moving higher, you want to buy them which are out of the money, because now you see the momentum going towards there. So instead of, if your call goes like it did, the ones from $5 to almost $16, 5 or 6, the Netflix 367 calls, why the heck do you want to keep on holding the 367s? You take that profit and you take a bunch of the profit, leave some on the side, and you buy the 380s, or you buy you can buy the 385s. So that's, it's a very simple thing. You bank your money, and then you use part of that to buy the cheaper forward calls, what we call rollovers. Anything, it's called a rollover anyway in the business. So you roll over your strikes to a higher strike, and you pay less for it. So you understand that part, right?
Yes, I do.
Okay, good. So you'd be surprised how many people don't get it. They're like, oh, I know you originally you said to buy the 350 calls. I said, yeah, because the stock was at 345 at that time. But as it's creeping higher and it's moving big time, it's at 370. Why the heck are you still holding the 350s? You got to sell them and roll them out to the 370s. So anyway, so this is where we are. So the way you read this chart, without talking about option strategies, is we were in a, there's a big gap here. This was a ascending triangle, bullish chart. The real break on Netflix hasn't even started yet. If Netflix on earnings, in my opinion, that's just my opinion. So far, I've been pretty right on Netflix for a bunch of years now. I believe that it's going to retest the famous 420 level. That's my opinion. Based on pattern symmetry, based on the fact that I believe their business overseas is really gangbusters. So last time it fell. And it was back here, I think. When was the last earnings for Netflix? Yeah, in July. Yeah. So it had fallen. So bottom line is, can it climb back to 420? Sure. Can it find a big roadblock at the gap fill and then pull down? Absolutely. So I'll be, this is a stock that we trade on a regular basis, so I'll be passing on what I see. But so far, that's how you read the chart. A gap fill is always a magnet. We're almost there. Will we get into it? We don't know yet. So far, if techs cooperate, this is the zone you want to be out of Dodge. You know what I'm saying? That's it. You don't want to be like, and if it breaks out over it, you want to get into it again fast, because that means the stock is going to go to 400, 410 like right away. Downtrend lines, channels, downtrend channels, patterns, ascending. You see that ascending triangle right there. Very, very important. Ascending triangles break out, then they come back to retest it. So a couple of bucks down doesn't kill you. You want to use that opportunity to buy it as long as it doesn't break below this line here. That's why I have this channel. You see this? You see this channel here? So there's a lot of things going on here. There's a gap here. You see the gap?
Yep.
There you go. So if it can easily come back, retest the gap, and bounce like this. However, if it falls below the gap, then the stock will retest again the 363 level. For Netflix to move back and forth, 8, 10, 12 bucks is nothing. So if it doesn't hold the gap and it breaks below, there's a high probability it's going to be down those $9, $10 and retest this uptrend line, which started all the way back in August. See this? So
Right.
that's how you read this chart. So all right,